Well, 11 o'clock on the nose, and, goodbye once again to Costa and Mike Crone, Petro Van Vaca. We had Dave Paleologos, and now rounding off our Dream Team Tuesday, the day after Memorial Day weekend, is Manny Frangiadakis, 12 points, wealth management, along with Stamatis Astras. And from my understanding, the market just keeps climbing and climbing and climbing. It's like a Spider-Man effect. Good morning, and to talk about it is Manny.
Good morning, Calimera.
Hi, Manny. How are you?
Doing well. How are you guys?
All good, all good. The tech market, Nasdaq is up all of a sudden. What is it, 1% right now? Yeah, it's 1% all of a sudden. We are reaching highs there, 52 highs. Close to a 52 high range. And Dow is flat. S&P is a little bit. S&P is up almost, almost a percent.
Yeah. Last time I saw the Dow, the Nasdaq was up 1.7%. Small caps were up 1.3%. S&P was up more than 1%. You're hitting all-time highs again in these indices. Stocks continue to climb whatever wall of worry you want to put in front of them. And this is all in, from my standpoint and from our team's standpoint, this is an anticipation of a deal taking place between the U.S. and Iran as it relates to the ongoing conflict.
Has to be.
Of course, it is. I mean, there's nothing else. There's nothing really market moving out there right now. You've had some earnings reports, but not the ones that would necessarily move the market, like BJ's reported. You had Ross Stores reported, but all your big names that would actually have a impact on the indices have already reported. The other news is you have Warsh as the new Fed chair now, and people are anticipating what his, administration, for a lack of a better term, would look like. But again, there's 12 voting members, so necessarily, changing the Fed chair doesn't necessarily, have a true impact on monetary policy. And that's really it for your headlines. I mean, right now the market's celebrating the fact that oil is lower, that you've seen the yield in the bond market kind of get reined in from a pretty explosive spike in yield last week. And the stock market is celebrating all of those factors.
Manny, what do you know about this Fed chair? Who is he? What's his background? What do we know about him?
Yeah, so he's been campaigning for the job for quite a while. He is very, close to the Trump administration. He comes from a very business background, less so than Powell, who was more private equity. He is, wealthy in his own right, but he's also married to his wife is one of the heirs to the Lauder fortune.
To the what fortune? To the what fortune?
The Lauder fortune. So when you think about beauty and cosmetics, yeah.
Okay, S.D. Lauder. Yeah, okay. Yeah.
So, but he's been in a life of finance. This is his first time really in a political type of role, or at least a public role.
How old is he?
But he is going to be pushing for a number of things. I don't think necessarily he is a fan of higher rates. I think he campaigned and got Trump's buy-in from the standpoint that he agreed that interest rates should be lower. Mm-hmm. I also think he has a number of comments as it relates to the Fed balance sheet and tapering off the amount of bonds that are on the Fed's balance sheet, which could be a form of loosening policy in and of itself. Because you think about it, more supply yields will come down. But, we have yet to hear from him. He was sworn in last week, oddly enough, at the White House. Normally when a Fed chair gets sworn in, it takes place at the Federal Reserve. But he was sworn in at the White House. And President Trump told him he expects him to be his own man. But in the very next sentence, said that he wants the strongest economy ever in U.S. history during his tenure. And that, most likely to be able to do that, you're going to need lower interest rates.
All in all, are the people in your industry, pleased with this decision, or indifferent, or too early to tell?
I think it's too early to tell. I think it's indifferent. And I think the Fed is always slow to move. As I, started the conversation, there's 12 voting members, and Powell is going to be one of them.
Yeah.
And I think there's there's not a great deal of love between Trump and Powell. And so I think he's staying on as a Fed voting president, just strictly out of spite. But we'll see how it works out in terms of, and not to say that, coming out of the Powell administration or tenure that you had like voting members moving in sync. I mean, you had a number of dissents, which is, more unusual than previous Fed chairman regimes in terms of whether or not rates should be higher or lower. I would also say that the one caveat out there is one of your more, I would say, dovish Fed presidents has now turned a little bit more hawkish as it relates to their opinion on interest rates and monetary policy. But a lot of this is going to depend on, what takes place between Iran and, the United States. And if we can get a deal done, then oil will go back down in price. I don't think we'll see 65 for a while, which is where it was, right before the conflict started. But a lot of that is going to affect the data as it relates to CPI and PCE and core inflation, which will dictate the decisions and behavior of the Federal Reserve as it relates to monetary policy.
Very good. Very good. Stamati, anything resonating with you?
Well, it's amazing. You still have bombs falling this morning. People are still negotiating on the same time. I think it's just the
yields falling. Bond prices have caught a bid.
Yeah, so it's a self-fulfilling. Everybody says this it has to happen, so it will happen, and that's what it is. I think we have to take a look back, 3-4 months ago when everything was down. What was it? 10%? What was the low? It was down 10% or 15%. I don't think it reached 20%.
No. It was down around there, and that was back in call it, beginning of March is when this really started. The conflict started, and that's when you started to see stocks trade down. And since those March lows, the S&P is up 20%. Since that period, but year to date, you're talking about some pretty strong returns from some of these stocks that are out there. I mean, the semis are up 5% just here today.
So you have to you have to pause and wonder. It is always, they say, you have to stay invested, be cautious. You buy on the dip a little bit, diversify. You got to do all these things. And yes, there's bad news in the world, but 3 months later, everybody forgot about it. I mean, remember Venezuela?
Mm-hmm.
That was in January. Nobody remembers that anymore. So now we are in all-time highs, and I guarantee you it will go down. So we just have to be very cautious and smart about it, and again manage your personal needs and the cash flow needs you have, and the tax needs you have. But I think we live in a world now that you got to be invested.
Yeah, you have to be invested, but I also think there's something to be said about this current market cycle, and I do think that. Your equity risk premium right now is negative. So what's the equity risk premium? It's the inverse of like your, price to earnings ratio, which means like what is the dividend yield of the S&P 500 in terms of compensating me compared to the risk-free rate of return of, a treasury. So that's negative compared to where treasury markets is right now, which is the market essentially telling you that they think bonds are riskier to own than stocks. Normally you have a positive risk premium about 3 to 4% in normal markets, which makes total sense because you are getting compensated for the opportunity of volatility and drawdowns, which usually don't take place in treasury markets. I think that in itself is a sign, and I think that in of itself has caused a lot of hedge fund managers and a lot of people that have been in financial markets for 40 years to be underweight right now. And I do think, at some point they will be right. Value will be right. And you will see, that relationship with the equity risk premium start to flip again. Not to say that can't be another 1 to 2 years out. But right now, I think, if you were going to say I'm an investor in stocks or in the U.S. stock market or even the global stock market, you would probably have to look for the next 3 years to almost be flat to negative like returns just due to where the equity risk premium is. So the opportunity to right now, after taking this bullish ride, is to diversify potentially out of equities, trim down. I think if you don't own bonds right now, I wouldn't necessarily do it today because I think there's some more volatility as it relates to yields. But I do think bonds at some point will become a very, very attractive buy because they've been out of favor for so long. And I also think that, your commodity super cycle that we've talked about in the past is still very much in its early innings and something that is going to pick up steam for years to come. I wouldn't necessarily jump into it now. I think that, if you wanted to pick one or two, like oil will go down once you have a peace deal and trade, sideways for a while. But eventually, long term, we are very bullish on oil. And the same thing relates with as gold. I think gold right now has a date with its 200-day moving average at some point, and then it consolidates there, and then it's getting ready for the next move higher that, for years to come. And I do think that, coming out of any deal with with Iran and the U.S., behaviors of governments are going to change. I mean, there was an article this weekend in the Financial Times that the European Union is now going to start stockpiling fertilizer in the event and with expectation of a potential, food crisis down the road. So you're going to have countries now stockpiling commodities, which are going to send, commodity names a lot higher. And I think that's a cycle that lasts for years. So right now there's opportunity to get out of stocks and potentially get into some other asset classes. But to Stamati's point and what we've said many times over, this is why you have to stay invested. You can't go to a 0% equity exposure. You have to have exposure, but you need to know what you own and where you own it at and have a game plan of why you own it and when you're going to exit from that position.
Very good. Very good. Anything else?
There's not much right now that's going to change the direction that we're going in. I think that my expectation is that the market is telling you right now that we're closer to a deal with Iran than we have been in previous times when you've seen these, markets rally. The only thing that, sticks out is that uranium piece as it relates to their stockpiles and what's left. What happens there, that could either drive a deal forward or potentially allow this one to collapse as well. But the market is telling you that they believe that a deal will be had here. And I think once you do have, a deal announced, you probably see, a move to the upside. I don't think you're going to see a 5% move on the deal announcement, but could you see a 1 to 2% move higher in stocks? Yes. But I would also expect that probably then trims down where it becomes a typical buy the rumor, sell the news event, because the market has been running hot for a while in anticipation of this deal. And once it gets announced, I would expect after maybe a couple hours or even a day that you see stocks sell off at that point.
Kind of makes sense based on what we've seen. Anyway, Manny, always such a clear way of showing us the road, kind of like you're looking in the crystal ball. But nonetheless, Manny Frangiadakis of 12 Points Wealth Management, you can experience the freedom of securing your own finances, meeting and exceeding your expectations through clear, as you see, consistent communication and attention to detail like he brings to us each and every Tuesday. Manny Frangiadakis, 12 Points Wealth Management at 617-212-8343, 617-212-8343. Manny and Stamati, have yourselves a terrific afternoon, and God willing, we'll regroup next Tuesday at 11 a.m. Nasta kalapidya. Bye-bye.
Thank you.
Bye-bye.
Thank you, guys.
Bye-bye. We'll be right back after these